All right. We are live, I believe. We're live? Awesome. Let's rock and roll. Hey, good to see everybody here. We are excited to be sharing today. We are answering some questions. Transaction volume in real estate is down by 70% this year, and interest rates are higher than they've been in 40 years. But there are still major opportunities to be had in real estate. So today we're asking, how do you find those deals? How do you fund those deals? How do you structure those deals?
Go away from him. I'm sneaking over his computer.
And how do you get those deals to the closing table? We're going to be answering that and more. We have our boardroom clients on the Zoom right now. They're going to be asking questions, and we're going to be answering them. If you are live on YouTube with us right now, you can also ask questions. Just put it in the description or in the comment section, and we'll get to those. We got Larry and Randy here. We're partners, and between us all and our team, we have over $500 million in assets under management, and we are still buying deals this year in 2025. Our team, we just had a guy close just last week, 2 weeks ago, 48 units. We've had several deals like that, and so today we want to talk about what does it look like to structure these deals. Where are you going to find them? And so again, put your questions in the channel. I'm going to bring up a few that are already in the queue that people are wanting to know. And so let's kick it off. Some people are saying you should freeze and not buy any properties right now. With the current market conditions, some people are saying you should look at the bond market and just watch that, wait a couple years. So why don't we start with Randy? What are your thoughts on that, and what kind of advice would you give there?
Yeah, I mean, I think ultimately, people say, hey, just freeze. It's like there's a lack of understanding of where we're at, and maybe also a lack of understanding of the structural support, meaning the demographic trend of, multifamily and housing needs. So the first and foremost, the bond market, the 10-year treasury is your typical driver that drives real long-term fixed rates. Right now it's, hovering around 440. Earlier, probably October, pre-election, it was about 380. A lot of the near-term, tariff and chaos and stuff like that going on, and concerns of inflation have elevated the bond market. And so what that means, or what it's a concern for people, it's like, your Fannie Mae, Freddie Mac HUD loans, which are your typical fixed rate loans that are the agency-backed loans, your greatest, call it lower rate and longer term in the multifamily space market, are driven by that bond market, not by the federal funds rate. And so, you got to look at where we're at right now. Is there a reasonable expectation that rates would come down over the next 24 to 36 months? Probably some. Everybody was praying and hoping. There was kind of the story before of stay alive to 25 kind of thing is what people talked about with interest rates. And again, we'd been saying all along, interest rates are going to stay higher for longer. And I think we're ultimately in a higher interest rate environment. That being said, you can still buy a deal today, as you evidenced by some of the REI members that just closed, and make money. And you just have to find the deal that's supported by it. I mean, we've bought properties in the past when, the rate was, call it just under 6, and right now you can probably get an agency loan right about 6.25, depending, with buy down or, and you can still make money with it. So now if you wait, let's say 2 years with a belief that, hey, rates are going to come down, and when rates come down, I'm going to buy it then. Well, that means most likely, price could be up if you're talking about a stabilized deal, because again, the components are, income, interest rate, those are two huge drivers. So just saying, hey, I'm going to wait till I see interest rates come down, you're not really factoring in as rates come down. You also probably see that support higher pricing. So if you're able to go in and find a good deal that works in today's interest rate environment, and then rates go down, I mean, they're not going to go down to like it was before. I mean, it's, probably a neutral rate of about 280 to 3. you are still moving down from where they are today at 4.25, 4.5, and that's going to help boost your value of the property in addition to the value add strategy that you're doing. So, I think it also, it's a more difficult time right now. And if you're honest, probably more people have a little bit of fear or apprehension.
Right.
And so the easier thing to do if I'm scared is to, I'll just wait and see what happens.
Right.
I mean, people were saying that in 2016.
Right.
But I think, I'm going to wait and see what happens. And what happened is the market continued to go all the way through 2021. So, lost out on a huge cycle of opportunity.
Yeah, and a very wise person said, look at what everybody else is doing and do the opposite. Right? You can make money in any market.
That's right.
The principles are all the same. And in my opinion, you just have a big advantage. There's no doubt a lot of people got messed up by the interest rates rising, right?
Oh, for sure.
But if you're starting today or if you're picking up today, you have a huge advantage because you already know they're high and you're underwriting accordingly, right?
Well, that's really the key. Larry just nailed it, is underwriting accordingly. Now, some people, because of, and again, let's not call it scared, but fear or concern, oh, I'm worried. It's like, it's a root of fear. Like, I'm scared about what may happen, or I'm uncertain about what may happen. But it's like, if you're underwriting it properly, you're factoring in the present moment, the present interest rate, you're factoring in what your exit cap rate would be. And then, you're able to look at that and say, look, I can actually buy this deal, renovate the property, drive rents, make money in the current environment. And, if rates stay the same, I'm still making money. If rates go down, I'm increasing the value even more. And if rates go up, I'm still making money because I used a fixed rate loan.
Right.
Right. And so, ultimately, that's the thing. And there's, there's more properties that are no doubt, anybody that brought a property and say, call it into 2020, 21, 22 with non-fixed rate debt, there's pressures on that on some level, shape or form. It's just, that's the truth, because interest rates are up, inflation's up, costs are up, labor's up, insurance is up, those are all truthful things. And then that's also what makes people a bit nervous. But if you're honest also too, one of the things that I would say is a true thesis is that, we're in at least a 10, and I'd say more like a 20-year channel that the question is, are you going to have more people that need to rent or less people that need affordable rent? What's the real answer?
Right. Yeah. That's so good.
More people.
Yeah, I was just reading someone say, inflations, elections, tariffs, interest rates, there's no such thing as a perfect market. So I keep buying what makes sense. Off market, great location, classic value add, nothing shiny or new. They said the market doesn't decide whether I move, it only tells me how.
Mm-hmm. Yeah, no, that's great. That's great. Look, I think a lot of times, a lot of the listeners or people out there, if we're honest about things, and we always try to just shoot it straight, it's like, look, you've seen, these ring, bam, boom ads on Facebook or Instagram or whatever about, hey man, you can make money in your sleep. And it's like, the truth of the matter is, it has its challenges, right?
Yep.
But the challenges pay off with a big economic reward. And, that's the truth. Like, you could go back as far as the 20s in Napoleon Hill and Think and Grow Rich.
Right.
It's like, part of the reality of gaining that economic freedom comes with a cost. Part of that cost is you've got to put in the work. And, and this is part of that moment. You've got to put in the work to find a deal that makes sense in this moment.
Yeah, exactly. And number one thing is we need to know how to navigate the market. And by the way, guys, we are live on YouTube, and we also have our boardroom members in here that, and so if you have questions, drop them in the comment section. We are going to answer them live. We are talking about how to navigate the current market, how to buy properties in today's market, how to adjust your underwriting, how to adjust your strategy and your structuring based on the current conditions. And so right now we're talking about the current conditions and what that looks like. But I want you guys, if you want to get an answer, get a question on something you're working on or a situation you have, we want to answer those. So drop them in the chat if you're a board member in the Zoom call or YouTube on live. Okay. Randy, you mentioned, we talked about the bond market, and can you just describe like why that's relevant, the bond market, to the current state of investing?
100%. A lot of times people, and especially the media, focuses a lot on the Federal Reserve and Powell, and then the conflict between Trump and Powell, and what's the chair going to do, and they didn't move interest rates down. The Federal Reserve really trails the bond market, or trails what's happening basically in the open market, the Treasury market. And the Federal Reserve, when they change interest rates, all it affects is short-term variable rates that some loans are driven by, like kind of your bridge debt loans or credit cards or auto loans that are non-fixed, or lines of credit for like businesses and manufacturing companies. But the bond market is really the driver for your home mortgages, your 30-year mortgage for buying a home. And it's also your driver for the mortgages on apartment complexes that are 30-year mortgages driven by Fannie Mae, Freddie Mac, or 40-year mortgages driven by HUD, Housing Urban Development. And so that is critical, because those are the big, lenders, if you will, for stabilized type properties. And ultimately that's where you get your fixed rate long-term debt. And so the bond market is not driven by the president, or it's not driven by Powell. It's driven by market forces of supply and demand. So as more people plow money into the bond market to buy bonds, the price of the bond goes up and the yield goes down. It's an inverse relationship. And when more people pull their money out of bonds, the price of bonds goes down and the yield or the rate goes up. And that's what we've seen in the near-term moment with kind of the scares still of tariff inflation. The other driver of that there are countries, that huge investors in U.S. Treasuries. The U.S. denominated dollar is the world currency for trading. And a lot of those countries have pulled back from their, Treasury holdings. And that's also kind of a tit for tat with Trump and all that. So it's important for you as an investor. Most people don't even understand that.
Right.
And if you get an understanding of that, it's going to give you an advantage over other people, because you're beginning to able to at least understand, hey, where are we at with interest rates? What is expected to happen? Not just this kind of blind hope or thought like, hey, rates are going to come down. It's like, rates aren't probably coming down that quickly right now,
right,
because of the economic forces behind it. And so the people that are waiting for rates to come down are going to keep waiting and then miss out on opportunity that other people are going to be able to take advantage of.
Well, let's dive into that, because exactly what you said is the burning question, right? We need to know, how are you underwriting deals with the current interest rates? How are you structuring deals? What are the plays? Because we have people really leaning heavy on seller financing. In this situation, they're only looking for sellers willing to carry part of the deal, part of it back. I mean, it just doesn't make sense without it, and that's their one strategy, right? There's people getting creative, using different types of financing, different types of structures for the deal. And maybe we can start with this question. If you had to start, and maybe this is a big one, right? If you had to start over today, in today's market, you were dropped in today's market as a beginner, how would you go about getting back to where you are as fast as possible? Maybe, Larry, you want to
take that?
Yeah.
Yeah, I do the same thing I've been doing since I started.
Yeah.
Just may have to do more of it and do it a lot harder. But, when I first started, I made up for my lack of skills and knowledge by just working really hard.
Right.
Now, hopefully, my skills and knowledge are a little further along, so maybe I don't have to work quite as hard, but I'm just going to do the same thing I'm doing. I'm going to talk to as many sellers and potential investors as I possibly can, and only focus on solid deals. I mean, that's all we've ever tried to do. Not doing a deal just to do a deal, but doing a solid deal where you're getting pretty much instant equity when you purchase it.
Yes. Yeah, that's good.
The other thing I'd just throw in to add to that is, I would more quickly be a part of a group like this. because, I think for most of us, at least I know for me, I started off on my own for years, and I had some mentors, but, before I really connected together in a more mastermind format. And there's a lot of value because you're gaining from the leveraging other people's experience. And even as Larry just said, you're connecting together with more investors more quickly,
Yep.
more other people that may have advanced knowledge that can benefit you. There's just an acceleration that can take
Yep.
place by doing that. And so I think the faster that you can do that, the quicker that you're able to move ahead.
Right.
By taking advantage of other people's mistakes that you've learned from and their wisdom.
Yeah, exactly. So let's get into that a little more. I mean, what are you looking for in today's market? How are you underwriting differently today than you would in years previous? And how are you deciding how to structure the deal? And really the premise behind that is so that we're not overcommitting but also not staying stagnant, right? Not just waiting like a lot of people are.
Yeah. Well, I think you've got to define what is the right fit and return for the equity that you're working with. And again, so if somebody has a smaller equity pool, and then they're looking at, like you mentioned, the deal at kind of the 27 or 48 unit deal, they're maybe utilizing the concept of the seller finance in conjunction with equity to be able to execute on a deal. We're looking at incorporating more institutional type focused capital in this moment in time to focus on properties that we would want to look at acquiring. Now again, for us, what we're targeting is 75 units and beyond, 100 units typically or more, and so that typically has a bit more of an equity component to it. If you're buying it for whatever $10 million, your equity piece is $3.5 million or something like that, or if you're buying it for $20 million, your equity piece is $7 to $8 million. It's really looking at that first. What does the return metrics need to be, and so that then that can be matched up. And then secondly, what is the overall deal level return metrics need to be, so that, as Larry said, it's a good deal. Or we historically have fashioned, it's like we're going to buy X number of great deals per year. Now it's been harder to do that in the most recent, going on 2.5 years, because of what took place in 22 with the interest rates just accelerating. That being said, we're working with seller direct component, we're working with broker component, we're working with distress component, and we're working together with different banks as well to really source deals coming in. And so with that, we've turned down virtually everything that's come through the door because it's just not good enough.
Right.
And Larry said this earlier. It's like, look, I got enough pain. I don't need to buy pain. You know what I mean? Like, right? Like, you don't do a deal just to do a deal, because you could do that.
Right.
And people did that. People did that in 21 or 22 or even earlier, and then it just instantly became pain. And so,
Yep.
You do a bad deal just to do a deal. Well, within 2 years or no more than 3, you're going to have pain. And so, I easily and happily say, yeah, we haven't bought a deal in the last 2 years because the numbers haven't been there to support what we're looking at.
Right.
And so, we've also passed on some deals that were, it was a 25 unit deal in the middle of nowhere comparative to where our footprint is. And it didn't make sense for us because, it just didn't have enough meat on the bone for us to dedicate resources to it. Now, somebody that was maybe their first or second deal, it could have been something that was good for them, but it didn't have enough on it for us to even just kind of, buy it and flip it. So it was a pass,
Right. Yeah.
Well, I was going to say that, the underwriting principles don't change. You're still looking for a solid deal. Interest rates are higher, so your debt's higher. So maybe you're targeting a little bit higher cap rate, but the principles are all the same. And like Randy said, it's tougher to get deals done. But a lot of that's sellers still stuck in the lower interest rate mentality, right? They can't grasp that my value of my property is lower. But they're coming around. And we've come close on a lot of deals, and close on one right now, and hopefully we'll get one done. But I think a factor of the sellers not being more realistic and us being a little more conservative, because you don't have to do a deal. Like you said, rewind that to I've lost everything and I'm starting over. I'm going to be pressing on gas a little bit harder.
Exactly.
Right? So,
Yeah, because there's deals in every market. It's just a matter of where they're at, how to structure them, get them to the closing table. And so realistically, what this means is we've got to increase lead flow. We've got to increase deal sourcing. We've got to increase our searching efforts, right? Because most deals don't make sense. And sellers are stuck in that mindset. So we've got to tackle that.
I want to interject here and just say something that, and again, I'm probably shooting too straight for too many people. I don't know, but like you got to work your butt off in any market, right? Like, so I go back to people in 2017, 18, where it's like market's going like this, man. People are competing to try to get deals, and like it was just a white hot frenzy almost all the way through to 21. Like some brokers wouldn't even talk to people, like, oh, you're a peon and we're not talking to you. You know what I mean? We had to work our butts off to be able to source and get a great deal when other people were just buying any deal under the theory of momentum, right? And so, and again, I'll say it a little bit, we worked our ass off to be able to do that, and we did it successfully.
Right.
And so then now in this moment, it's a little bit of the flip of that around. There's not as many deals. And so it's the same principle, though. You've got to work your butt off. Like you just said very clearly, what does that mean? You got to process more leads. You've got to go through more deals, because as Larry said, there's still more people stuck with my value is here when interest rates were 3.5, not 6.5.
Right.
And so, and I would just say this to everybody listening: if you're not willing to work your butt off, then you're not deserving of the wealth that comes with it through the pathway we're talking about.
Right.
And now that may seem tough, but it's the truth, right? Like,
we just lost a couple of people that were on the Make Money in Your Sleep.
yeah, exactly, right? They just said, "Oh God, I'm hanging up on this. I'm going to become a YouTube influencer, megastar, and make $1 million a year." You know, one of those people get that, and the other 150,000 that are trying to do that and shooting crap on their phone are getting exactly that crap. They're getting nothing.
Yeah.
You know, so, and I say that a little tongue in cheek because, look, I think if you have a burning desire of what something that God's put in you, you've got to give it all you got. And that's the truth. And I could go back to Napoleon Hill, Think and Grow Rich. It's like it's gonna cost you more than you're willing to pay. It's going to take you longer than it thinks, but the reward is going to be greater than you anticipated.
Wow. Good. That's a quote. That's good. Yeah. Well, and I think that, you know, there's still a major window of opportunity when it comes to the size deals that we're typically talking about. I mean, the guy just closed a 48 unit deal the other day, you know, and 27 unit a month ago. I mean, there's deals in that window, 20 to 100 units, that I just think is still a major sweet spot.
Yeah.
Because, you know, 70% of real estate investors are going after single family. The 5% are going after multifamily, and most of those guys are your institutional guys, right? And those guys are looking at deals over 100 units.
I like the 50 to 100. You know, I think that's a great spot, because some people are looking at just 100 plus. But, you know, to put a positive note on this, there's less people looking, right? You have less competition.
Exactly. Yeah.
So whether there's fewer sellers or fewer transaction volume, a lot of people are just still on the sidelines and waiting. And that's a good time for you to grab some of those deals, because some sellers are realistic. Some sellers have to sell now.
Right. Yeah. And I want to try to do one more question. We had Steve chime in about raising capital, and, you know, raising capital, right? So structuring the deal. You know, I just want to answer that question as far as investors being reluctant to invest their money into a deal, you know, in this market. How are we handling that? What would you advise as far as just, you know, getting more capital raised in today's market?
I mean, I think you have to acknowledge, you know, like, okay, there are a certain level of investors that are more conservative now because of what they've seen with some of the difficulties in the commercial real
Right.
estate environment. And so you have to address that. And then you also have to be able to address the reasons why the deal that you're buying is been to the level that it can be de-risked, meaning that you're accounting for, as Larry said earlier in the underwriting, a higher interest rate on your loan, a lower LTV that the loan's coming in, a more amount of cash or seller finance contribution that's supporting the deal, the actual cash flow that is going to be made off of the realistic rents that are there, not
Right.
pie in the sky. And then on the back end exit, that you're not making your profits off of some falsely assumed super low interest rate that's going to maybe or maybe not be there. And so you can demonstrate that to people and give them the assurances to see that this is a well thought out, well vetted, well underwritten quality investment opportunity, and the fact that there's still strong demand in that area, you know, for rentals.
To me, it's just a sales conversion equation, you know, from your investor pool. And there's no doubt people have dropped out of that investor pool because they heard some bad stories or their friend lost money or they lost money. But that pool is constantly being regenerated. You know, somebody just sold a business, somebody made a lot of money, is in another
Right.
industry, and they're popping in. People popping out.
And,
That's always
well,
how
and
it
even
is.
too, to Larry's point, some people just, you know, the market recovered, but it was down, you know, whatever, 18%, and they're like, good Lord, I don't want this in my stomach anymore like that. And so they say, hey, I've got a couple $1 million in here, and yeah, my money's back, but I'd like to take 500,000 of those chips off the table so it's not riding the roller coaster of the stock market, and put that into real estate. You know what I mean? So that is true what Larry said. There's always people that have a reason to look at investing in it. And then it's, you know, our job or your job to educate those people and connect together with them and help them to understand, you know, what that looks like.
Yeah. Well, I appreciate it, guys. So we're going to cut this one a little bit short, but I think sum it up, finding more deals, finding better deals comes down to just generating more off-market deals, you know, and one of the big things that's winning for our investors that are in our mastermind is VAs and getting out there and creating relationships direct to seller. You know, we recruit virtual assistants, and you know, there's deals, just you wouldn't believe how many deals every single day are being underwritten by our underwriting team, and there's a lot of good deals out there, guys. So appreciate you joining us, and look forward to the next one. God bless,
Have a great
guys.
day, guys. Thanks so much.
See you, Randy.